Hey everybody, and welcome back to Investing with Wesley. In this channel, as you guys already know, we talk about everything that has to do with investing, economics, personal finance, anything that has to do with money, really. And today's episode, I want to dispel one really big myth that a lot of investors believe in. And that is that you need to take extra risky bets in order to get extra big returns. Today's episode, I'm going to explain to you how that is just false, and with a little bit of creative thinking and ingenuity, you can actually get really good returns with very little risk. With that being said, let's get into it. Okay, so like I already said, the big myth that I want to talk to you about today is that you need to take extra risky bets in order to get really high returns. And like I said in the intro, this is just blatantly not true. This was made popular a few years ago with GameStop, the Wall Street bets, that whole era of meme investing. But even before that, it was common knowledge, or so people thought, that they had to get a little bit riskier in order to get bigger returns. This is why people go in the bond market from grade AAA bonds to junk bonds or high yielding bonds. In the world of equities, people will go from value or safe haven defensive stocks to growth speculation in an effort to get greater rewards for seemingly even greater risk. This also translates into options. People will, instead of investing into the equity themselves, they'll leverage their money, take on more risk in a hope to get greater returns in option contracts. But realistically, even though some of these methods do actually work, there's really no reason to take on that much risk, especially when you're working with your retirement or just a very large portion of your savings. And even if you try and mitigate your risk by only investing a fraction of your savings in these ultra high risky investments, well, then you're still risking that portion of your savings for a return that's realistically not worth the amount of risk you're putting up. Now, these low risk investment options that I'm going to be talking to you about today aren't very common. It's not like you can just open up your brokerage account, type in some sort of ticker symbol, and you'll be set. If you want something like that, then I've made plenty of videos explaining to you exactly how to pick really good dividend producing value companies. That's about as safe as you could get in the equity market. But we're talking about general investing, and in that sense, people need to open their mind on really what investing is, and that is trying to grow your income, trying to grow your wealth and your assets over time, and in a pace that you could retire or live financially free sooner rather than later. Now, I also want to point out that to do some of these investments I'm going to be talking about, you actually have to go through an investment advisor or some other fiduciary, because most of them aren't just readily accessible to the public. But the first one is called a structured note. Now, a structured note works very similar to a bond, but as it sounds, it's structured differently. Now, a structured note is you give your money to a bank, and that bank invests the money for you. But not so much as paying someone to invest for you. You don't get all the gains. Instead, the bank invests that money or loans that money out with an interest rate. And at the end of the agreed upon term, you get your entire principal back plus an agreed upon set amount of interest, whichever is greater. So if the banks didn't know what they were doing and didn't invest your money properly or lost money, then you're still guaranteed to get your total principal amount back. You didn't lose anything. But if the banks were smart, they were able to grow and they were able to invest properly, then they'll give you your principal plus a little bit of the interest that they earned, and then they'll keep the remaining interest for themselves. Structured notes have to go through a fiduciary or investment advisor and are pretty hard to come by because they're one of the most popular investments that are super low risk. So as you would assume, everyone, once they find them, just gobbles them up and buys as many as they can. But nonetheless, it proves the point that really good investments can be made with ultra low risk. The next one is more of a product than an investment. But if you're looking for low risk investments where you're not really risking the loss of your money, only gaining money, then a fixed indexed annuity could be something you can consider. Now, if you've been following this channel for a while, you know I'm really not that huge a fan on any sort of annuity. However, the fixed indexed annuity is probably the best one of all the annuities out there. And that's because you can give your money or put your money into this annuity, and the insurance company that annuity is with will invest your money. Now, the way a fixed indexed annuity works is that when markets go up, you get a portion of the profits as well, similar to the structured notes. But if the markets are going down, then you are guaranteed that fixed amount of interest. So if the market goes up, you get those percentages. But if the market goes down, then you don't lose anything because you're guaranteed to get at least zero, never negative. Now, annuities come with fees because the insurance companies carrying this risk, well, they need to get paid too. So is the comfort you get from having little to no risk, and are the returns you're expecting great enough to pay for those fees? Usually fees for annuities are anywhere from 5 to 8% a year, so extremely expensive. But nevertheless, it's a great option to park your cash that is safe, reliable, and very little risk. Now, the third investment product is a market fixed CD. Now, similar to the first two, it's attached to the market, so you get market performance returns, but it's also fixed at a certain amount. So usually market fixed CDs are CDs that are fixed to the normal CD rate. In this case, it's a few percent, plus you get rewards from the markets that are invested in. So if the markets go down, you're still guaranteed those 1 or 2%, but if markets go up, you get some of the upside as well. So again, all three of these options are ways that you can invest in the market and get market rate returns of 10 to 14% depending on the year, and really expose yourself to very little to no risk. Now, the next two I want to talk to you about today are kind of out of the box thinking. They're a little bit more creative finance side, but nonetheless, great investments, great returns, and a little risk when researched properly. The first one is a story I heard a famous hedge fund manager do, and that is he spent over $4 million in nickels, the coin of a nickel, a 5-cent coin. And that was because at the time, the actual value that went into creating a nickel was about 6.5 cents. So he was able to turn a 5-cent coin melted down into 6 cents and got a return that way. He turned $4 million in nickels to a pretty large return of about 36% just buying nickels and melting them. And he did the exact same thing for older pennies when they were mostly made of copper instead of zinc. He melted everything down for the melt value, sold off the raw metal, and made a profit. Now, I'm not going to give you this guy's name or pretty much any other details, and I'm not telling you to do this because, well, destruction of a United States currency of any form, that's illegal. But the last one is a completely legal and completely viable option, and that is tax lien investing. Tax lien investing is a way where you could passively purchase real estate and invest in real estate, but you're not actually controlling the real estate. You're not actually risking maintenance and repairs. You're basically just buying someone's tax note. Someone that owns a property failed to pay their property taxes, so you bought that property tax note or that lien in an auction, and in return, when that property owner gets noticed and does pay those taxes, they'll have to pay the taxes plus interest. And since you bought the lien, you get all the tax money that you put up, you get your principal back plus a little bit of interest. Now, the downside is if they don't pay their taxes, they continue to not pay their taxes, then you have the option of foreclosing upon them and just owning the home or the piece of property outright. Now, this is kind of a more savage way of investing because if they don't pay their property taxes, you can kind of kick them out on the street and take their home from them. But at the end of the day, an investment is a way for you to make money, and hopefully you can make that money in the form of your principal plus interest or in the form of taking control of that property, selling it, and collecting the profit. Either way, all of these options we've talked about today are very low risk for the amount of return that you could get. The expected returns for a structured note, fixed indexed annuity, and market fixed CD are all market rate returns, with the structured note being just under a market rate return because the bank keeps some of the profit for themselves. So with a structured note, you can expect 6 to 8%, whereas a fixed indexed annuity or a market fixed CD, you can expect 10 to 12% returns like the market gives you. The out-of-the-box nickel investing method really just depends on the precious metal prices and what you can get the precious metals for. But the tax lien investing is a completely viable strategy with very little risk if your due diligence is done properly. You can get returns anywhere from 12 to 18% and double your money with the rule of 72 extremely quickly. And like I said, if that doesn't work, you can always foreclose, sell the property, or renovate and rent it out and turn your tax investment into a full-fledged property that you own outright. outright. So although there's a little bit more risk with the tax lien strategy, ultimately the rewards greatly outweigh the risk. With anything you do, when it comes to low risk, high reward investing, your goal is to only risk 3 to 6 cents in order to make a dollar. Think about it whenever you decide to invest your money in some places. Another creative way of investing, or a creative way of looking at investing, is private ATM ownership. You can spend about $3,000 on an ATM, put it in a prime location that gets a decent amount of traffic, and collect a small fee off of every single transaction. On average, if this is done properly, you can get $300 to $600 a month, and year over year, that's about a 20 to 36% return on your money. So for all my new or inexperienced investors out there, don't just run headfirst into the most risky investments, hoping to, in a sense, hit the lottery. Do your research, learn, get educated, because even though you might delay your returns by a year or so while you take courses and learn what you're doing, it's better to delay your returns than to lose money over and over again and learn by trial and error. Hope you got value in this video. If you did, please remember to like and subscribe, as it really helps this channel get out there. If you have any questions, comments, or just want something addressed, I have a dedicated Facebook, Instagram, and Twitter, or you can just leave a comment down below. Either way though, the choice is yours, and I'll see you in the next episode.